I'm Matthew Previtt. I'm a CPA here in Massachusetts. Since 1990, my firm has represented taxpayers before the IRS, the Mass Department of Revenue, and other state tax agencies. We are a small tax resolution firm that offers very personal service. I'd like to discuss now the different options to resolve your tax problem. And when I say tax problems, I mean a collection issue. You owe money to the IRS. There are several different options that might apply to you. The first is the statute of limitations on collection. I've met with clients over the years that had liabilities that were 6 or 12 months or 2 years away from running out the 10-year collection statute. Sometimes the easiest and the cheapest thing to do is just to do nothing. If the IRS isn't bothering you, you wait, you run out the 10-year clock, and when the statute of limitations expires, as long as the IRS doesn't file a lawsuit on or before the last day of the 10-year statute, essentially the taxes expire, and then they zero out the liability, and you don't owe it anymore. So sometimes that's the cheapest. It's not always the quickest. It depends upon the situation. Another potential option is clients come to us and let's say they can't afford to do a payment plan, or they don't have the money to do an offer in compromise. So maybe we get them declared currently not collectible. And what that is it's a way to show the IRS that you don't have any money after basic living expenses to pay them anything, whether it's a payment plan or an offer in compromise. And by getting somebody declared currently not collectible, essentially what that does is the IRS puts you on hold as far as collection activity. They put you in what they call status 53, which is uncollectible status, and they leave you alone. And I've had clients that we put in uncollectible status, sometimes so long that they ran out the 10-year collection statute. So that's another possibility. It's generally not a solution in and of itself, but it oftentimes can relieve pressure so that if the IRS is levying your paycheck, we can show them you don't have anything left after basic living expenses to pay them. And so if we get you uncollectible, they will then release the levy on your paycheck. And essentially it'll give you time to either make your life better, maybe earn more money, or run the statute, or figure out a long-term solution down the road. Another option is an installment agreement, and there are two types of installment agreements. The first is where the financial information shows that after basic living expenses, you do have enough to pay off the tax liability over the remainder of the 10-year collection statute. So that's what we call a full pay installment agreement. Another option is what they call a partial pay installment agreement. A partial pay installment agreement is where we show the IRS that the amount you have left over after basic living expenses is not going to be enough to pay off the tax over the 10-year statute. So to give you an example, let's say you owe $100,000, and let's say there's 10 years on the collection statute, or 120 months, and you're only able to afford to pay $100 a month. Well, 100 times 120 months is $12,000. Assuming your financial condition doesn't change over that 10 years, you'll end up paying the IRS $12,000, and at the end of the 10 years, the rest of the $100,000 will expire and go to zero. Now, with all things, there are exceptions. It's extremely rare. It's only happened twice in my career, since 1990. But once in a blue moon, the IRS will file suit on or before the last day of the collection statute. And if they file suit in U.S. District Court, and for the state of Mass, it's the Superior Court, and they ultimately get a judgment, then they have 20 more years to pursue collection under state law. But that rarely happens. Typically, there are so many cases on the books. The IRS and the state of Massachusetts, and other states for that matter, they don't have the resources to file suit on all these. So it typically ends up being with the very, very large cases where that happens. Another issue to discuss is penalty abatements. Oftentimes, if somebody can pay off the tax, we get them on an installment agreement first, and then we look to see whether or not they have reasonable cause to abate the penalties. For instance, I had a client that between going through a divorce, she had an illness, her son had an illness, all of these events transpired during the time she should have filed certain tax returns. And as a result of that, we filed a penalty abatement with documentation, and the IRS abated tens of thousands of dollars of late filing and late payment penalties. So that's another potential option to help you deal with the tax liability. Another option, and it's not talked about a lot, is bankruptcy. Sometimes, not all the time, bankruptcy can resolve your tax problem. Let me just say that bankruptcy is extremely complicated. There are many rules and factors at play, and it's also a evolving area of the law based upon certain court cases around the country. But in a nutshell, certain types of taxes like income taxes, if they meet certain rules, can be discharged in bankruptcy, Chapter 7, Chapter 13. Certain types of taxes like payroll taxes or sales taxes or meals tax, basically where you're collecting your clients, your customers' money, or your employees' withholdings, those are what they call trust fund taxes. Since that's other people's money, that's never dischargeable in bankruptcy. So be aware that bankruptcy is very tricky, and if you go to a bankruptcy attorney, make sure that they practice at least 50% of their time is done doing bankruptcies, and they're aware of at least the basic bankruptcy rules, because it is very complicated. We do know, because we've been doing this for 20 years, what those rules are. And so I would suggest before you file bankruptcy, come and see us, and we'll try to determine if we think you are a good bankruptcy candidate. One common solution that's often advertised all over late night TV and radio is the offer and compromise. And there's 3 different types of offers, but I'll just talk about one. And that is the offer and compromise based upon doubt is the collectability, the old I don't have the ability to pay this type of offer. Unfortunately, there's so much misinformation over the last 20 years, and a lot of late night TV ads claiming that they can settle people's taxes for 5, 10, 15 cents on the dollar. And unfortunately, it's not true. Maybe 5% of my collection cases qualify for an offer. To do an offer, you essentially have to have little to no assets and little to no cash flow after basic living expenses, such that you can't pay the tax off within the 10-year statute. If you have equity in a house or a 401k, and or you have money left over after basic living expenses, which doesn't include cable, vacations, going out to eat, Christmas presents, and so forth, the IRS is going to want you to full pay. So what you need to be aware of is that offers aren't as common as the TV ads make it out to be, and what you should do is come to somebody like us who can determine whether or not that's possible. One other issue is, unfortunately, offers are also advertised as the panacea or the holy grail of solutions, and oftentimes there are less expensive solutions or quicker options besides an offer. So an offer and compromise isn't the end-all be-all. It is a good solution for some people, but many times there are other options that are quicker and or cheaper, and so you really need to work with somebody that does this full-time so they can look at all your options. My goal, typically my firm's goal in a collection case, is help you resolve the problem for the least amount of money. And so you need to be very aware of all the details and what your options are. Last but not least, I'd like to mention innocent spouse relief. Innocent spouse relief is essentially for someone who, let's say, is separated or divorced from their spouse, and there are taxes from a joint return that are owed basically due to the other spouse's income. And the taxpayer, the innocent spouse, didn't know about this income or had no reason to know about the income. So for instance, if you signed a return with $200,000 of income and you owe $50,000 in taxes, you're not going to get innocent spouse because you knew about the $200,000 of income. You signed a return that showed $200,000 of income. Innocent spouse is more for the cases where somebody gets audited. The IRS determines, let's say your husband was stuffing $100,000 in mason jars in the ground and only reporting $100,000, meaning he was earning $200,000 but only showing $100,000. That's the sort of thing where if you didn't know and you had no reason to know because you weren't living a $200,000 lifestyle, but a $100,000 lifestyle, you might be able to get off on innocent spouse. Innocent spouse is very tricky. And that, again, is best looked at by somebody that works in this field full-time. Please give us a call to answer any of your questions, and if you'd like to set up a free consultation, you'll get to meet with me or talk with me over the phone, whichever you prefer, and we'll go over your situation, discuss your problem, what options are available to you, and give you some information to think about in making your choice for a tax firm. Call us at the number above.